to Agoracom Small Cap Breaking News, your daily go-to source for the best small cap headlines for over 65 million investors since 2007. We are launching straight into a high-stakes, rapid-fire deep dive today. The theme we're seeing across the mining sector seems to be acceleration.
Definitely. Management teams are really capitalizing on these record gold prices.
Exactly. Pulling forward timelines, de-risking projects, and, well, aggressively converting those exploration hits into actual resources.
You got it.
So we've got 5 critical updates today from North America and Mexico, covering everything from near-term restarts right through to, bonanza-grade drill targets.
And the mission, like always, is to quickly pull out that core financial or geological catalyst from each press release.
Right. We're not just reading headlines here.
No, definitely not. We're giving you the specific numbers, the quotes, the assays, the NPV figures that tell you right away if this news is worth, digging deeper into yourself.
Looking for that tangible evidence. Economic anchors, project certainty.
That's the focus.
Okay, let's unpack this, and we'll kick things off with a company that's really leveraging existing infrastructure, trying to jump straight into production.
Which is probably the most efficient way to get to cash flow in this market.
Well, right.
If you don't have to build a mill from scratch, you save, years and potentially a lot of capital.
We are talking about LaFleur Minerals. They're operating up in Quebec.
Okay.
The headline is, LaFleur Minerals taps environmental resources management to fast-track Beacon Gold Mill restart in Quebec. They trade primarily on the CSE, symbol LFLR, also LFLRF on the OTCQB.
LFLR, got it.
So the core idea here, the investment thesis, it really hinges entirely on speed and timing. They own the Beacon Gold Mill. It's fully permitted, refurbished back in 2022.
Okay, recent refurbishment. That's good.
But here's the key financial anchor they're really pushing. The mill's last significant run, that happened when gold was only around $1,600 USD per ounce.
Wow, okay. Big difference from today.
Huge difference. The chairman highlighted that restarting now, with gold prices, pushing above approximately $3,800 USD per ounce. Well, it offers just unprecedented economic potential, they say.
Well, yeah, the potential margin expansion there is massive.
They're pushing hard, aiming for first ounces in early 2026.
Early 2026. Okay, that's ambitious. But, let's maybe challenge that $3,800 gold price point just for a second. It's optimistic, maybe?
A bit, perhaps.
The real de-risking factor here, I think, isn't just the current spot price. It's the fact they're basing their PEA, their preliminary economic assessment, on actual 2022 operating data from that mill.
Okay, explain that benefit. Using 2022 numbers, costs have changed a fair bit since then globally, haven't they?
They have, but when management uses recent observed operating data, they're providing a real-world cost anchor. For specific things like local labor power draw per ton, how efficient that crushing circuit actually was.
Oh, okay. Less theoretical.
Exactly. While, steel, big equipment costs, they've seen inflation. But the internal processing costs, they're grounded in something real. That cost certainty, especially compared to building something totally new based on future guesses, that significantly cuts down the capital expenditure risk.
Right.
It's all about that leverage, the huge spread between their likely 2022 cost base and today's, sustained high gold prices.
That makes a lot of sense. Okay, so we've seen financial leverage. Let's look now at geological leverage, a company maximizing near-surface grade to sharpen up already good economics. We're heading over to British Columbia now with Thesis Gold.
Okay, Thesis Gold.
Their headline, Thesis Gold extends mineralization at Bingo Zone, sharpening economics ahead of Prefeasibility Study. This is Thesis Gold Inc., trading on the TSXV as TAU, also THSGF on the OTCQX.
TAU. And this update, it's really all about continuity, and the numbers are, pretty stunning for a shallow target.
They really are. The headline drill result from this Bingo Zone, it's a long interval, basically right from surface, 89.3 meters, grading 1.10 grams per ton gold. And that starts at just 1.37 meters downhole.
Wow, 89 meters right off the bat.
Yeah, and you got to put that into context. This project already has a massive economic baseline from its 2024 PEA. We're talking a $1.28 billion CAD net present value after tax.
$1.28 billion CAD. That's a very significant number for a developer.
It is. So as an investor, you have to ask, right, is that number truly realistic? What are the kind of risks maybe that calculation overlooks?
That's the critical question, always. And look, that high NPV, it's driven heavily by assuming they get early, high-grade cash flows, which is exactly why this drill result is so important.
Okay. connects directly.
Right. Continuity of grade right from surface means a lower stripping ratio, lower initial mining costs. If they can actually pull those high-value ounces forward in the mine plan, get to the good stuff faster, well, the NPV number just explodes because it weights near-term cash flow so heavily.
So this result helps validate that key assumption.
Precisely. Now, sure, the big NPV might not fully capture things like political shifts, social license risks, common challenges in BC. But the economics they're modeling, they seem fundamentally supported by these shallow, wide intercepts.
Gotcha.
And one more thing to quickly note here, they also hit a deeper zone, different style of mineralization it looks like, included 1.90 meters, grading 80.02 grams per ton silver.
Oh, interesting. Silver kicker.
Yeah, hints of potential credits for other metals.
Yep.
Adds a bit more optionality to the whole project.
Okay, good point. So we've covered developers maximizing shallow value. Let's shift now to another company accelerating its timeline, but this time by proving continuity deeper down. We're heading down to Mexico with Heliostar Metals.
Heliostar. Okay, Ana Paula project.
That's the one. Headline. Heliostar's Ana Paula drilling delivers thick, high-grade gold and a faster path to a construction decision. This is Heliostar Metals Ltd, TSXV symbol HSTR, also HSTXF, over-the-counter.
HSTR.
And the intercept here is, well, it's pretty spectacular. 88.05 meters, grading 8.82 grams per ton gold. And that includes a richer core of 35.5 meters at 13.82 grams per ton gold.
Okay, that kind of grade over that kind of width, that's a game changer for project certainty.
Explain why.
Well, just for context, right?
Yeah.
A typical open pit operation aiming for, say, 100,000 ounces a year. It often works with grades much lower than that, maybe in the 1.5 to 3 grams per ton range to be profitable.
Right.
So hitting sustained intervals near 9 grams per ton, that fundamentally improves their processing margins, lowers the cutoff grade needed for profitable mining. It just makes everything work better.
And they're responding to this certainty, mobilizing a third drill rig now, specifically to compress the timeline for their feasibility study.
Speeding things up.
Yeah, they're targeting a construction decision that supports starting production in 2028, aiming for that 100,000 ounces per year mark.
But, okay, pushing fast, adding rigs, are they maybe sacrificing data quality for speed? Is there a risk they're rushing that 2028 target? It's a fair question. Always good to be a bit skeptical when things accelerate quickly. However, the release does specify this drilling is systematic.
Okay.
They aren't just, poking holes looking for flashy numbers. They're also collecting the geotechnical data, the hydrogeological data, all the stuff you need for proper engineering and environmental studies.
The less glamorous but essential stuff.
Exactly. Lenders, potential partners, they don't just care about grade. They demand that engineering certainty. So delivering that continuous high-grade core alongside the rock strength data, the groundwater info, that's how you build a bankable feasibility study.
The bridge to financing and actually building the mine.
That's it. So it looks like they're aiming for quality and speed together.
Makes sense. Okay, let's pivot back to Canada now. Shifting from development acceleration to high stakes, pure exploration, targeting those bonanza grades. We're heading to the Timmins camp, the Abitibi Greenstone Belt.
Ah, the Abitibi. Always exciting potential there. This is where risk and reward really change, yeah.
We're talking about Melchior Resources, Inc. Trades on the TSXV as MKR. OTC is MKR.
MKR.
Melchior. Got it. Their headline. Melchior targets high-grade growth at Timmins with follow-up drilling at the 1010 zone. And this drilling, it's a direct follow-up to, well, one of the most exciting intercepts we've seen reported this year, really.
And we absolutely need to highlight that original intercept to understand the strategy here.
Yeah.
They hit 77.40 grams per ton gold over 6.90 meters.
Which is already fantastic.
Right. But within that, they had 445 grams per ton gold over 1.2 meters.
Okay, 445 grams per ton. Practically speaking, in a belt like the Abitibi, what does that actually mean?
That is what geologists call bonanza grade. Simple as that. It means you've likely hit visible gold, like actual flecks or veinlets of gold you can see.
Wow.
It's not bulk tonnage stuff. This fundamentally changes the deposit model. You start thinking about potential narrow vein, selective mining, which can be incredibly profitable if you find enough of it.
So the value isn't just the ounces in that one hit.
No, it's the proof of concept. Proves that these super high-grade structures exist there, and crucially, that they might be continuous.
Okay, so how are they following up?
Well, the exploration strategy seems pretty well executed, actually. They're doing two things at once. First, they're following that known high grade at the 1010 South Zone with a planned 6-hole program, trying to turn that single spectacular hit into a measurable resource.
Makes sense. Chase the known heat.
Exactly. But they're also stepping out, testing a completely new, separate target called the Northwest Prospect. It's about 500 meters away.
And why there?
It shows similar geophysical signatures,
Nope.
magnetic responses, conductivity similar to other known gold zones on their property.
Yeah.
So you follow the proven grade, but you also use good science to hunt for what could be a completely separate discovery zone.
Right. So they're optimizing the immediate potential around the known hit, but also de-risking the whole property by looking for maybe a district scale kind of potential.
Precisely. Betting on two different geological fronts. It spreads the risk, in case that initial bonanza hit turns out to be just a beautiful flash in the pan.
Smart strategy. Okay, final stop on our rapid-fire tour. Let's wrap up back in the U.S. A company focused entirely on just laying the groundwork, the foundation, for its very first resource estimate, down in Arizona.
Okay, Arizona, building from the ground up.
We're looking at West Point Gold Corp, TSXV symbol WPG, and on the OTCQB, it's WPGCF.
WPG, West Point Gold.
Their headline reads, West Point Gold extends near-surface mineralization at Arizona's gold chain, clearing a path toward a first resource. And their focus seems laser-like. Just build the data density needed for that maiden resource.
And it looks like they're getting the kind of confirmation they need. 2 new shallow holes showing good near-surface continuity again. Hole GC2569, for instance, cut a pretty wide interval, 76.2 meters, grading 1.92 grams per ton gold.
And that included a higher grade zone within it.
Yeah, 32.0 meters, grading 3.17 grams per ton gold.
A solid
numbers, especially near surface.
Now, the company specifically mentions this is, quote, tightly spaced drilling designed to get the data density for a defensible maiden resource, specifically at the Tyro main zone. So, for the investor listening, why is that continuous mineralization right from surface so valuable, especially when you're talking about a first resource estimate?
Yeah, that's a key insight. Continuity from surface is a major de-risking factor when you think about actually mining it someday.
How so?
It translates directly to lower initial stripping ratios. That means you have to move less waste rock to get to the actual ore, which saves money, obviously.
Right, less digging.
Less digging. It also typically simplifies the permitting process. And it lowers the initial capital you need to actually develop the pit. So a maiden resource estimate that starts strong right at surface, it just has a far more attractive valuation proposition than one that only starts, say, 100 meters down, because those initial ounces are simply cheaper and faster to get to.
Makes perfect sense. Get the easy stuff first.
Exactly. And one more thing for West Point, they mentioned they have 15 holes completed now, but assays are still pending for 13 of those.
Oh, okay. So lots more news coming.
Yeah, suggests pretty consistent, potentially catalyst-driving news flow is likely imminent as they compile all that final data needed for the resource calculation itself.
All right. So let's try and tie this all together. 5 headlines, 5 different approaches, really. What does it all mean when we put them side by side?
Well, we've seen companies leveraging financial opportunity through restarts, like LaFleur.
Right, using existing assets. Then companies optimizing already massive value through shallow grade, like Thesis.
And others accelerating that high-grade certainty, like Heliostar down in Mexico.
Then you've got the big exploration bet on continuity with Melchior's Bonanza follow-up.
And finally, West Point, just methodically laying that foundational groundwork for future valuation with a maiden resource.
So a lot of aggressive moves across the board.
Absolutely. And if you connect this sort of aggressive push we're seeing across North America and Mexico, connect it to the broader economic picture. What it suggests, I think, is that management teams are not viewing the current high gold price as just some temporary blip.
They're acting like it's here to stay.
It seems that way. They're making these big construction decisions, financing decisions, development decisions, seemingly based on a belief in a sustained high gold price environment. They aren't, waiting for a pullback to confirm their strategy. They're moving now.
Interesting point.
Which, raises an important question for you, the listener, to think about for your own research based on the different models we talked about today.
Okay, leave us with a thought.
Given these aggressive timelines, the pressure to deliver, which project model do you think is proving most resilient? Is it the infrastructure restart, like LFLR? The near-surface bulk tonnage approach, like TAU or WPG? Or is it the deep, high-grade acceleration, like HSTR? Which one holds up best against potential future cost inflation or unexpected supply chain shocks?
That's the strategic calculation management is wrestling with right now, isn't it? Which path is truly the most robust long-term?
exactly.
Okay, that's it for this breaking news deep dive. You now have 5 specific companies, 5 actionable quotes, and 5 major catalysts to track, all hitting the wires pretty much simultaneously. We definitely encourage you to follow up on these symbols: LFLR, TAU, HSTR, MKR, and WPG.